Oil markets got shaky on Monday as shipping in the Strait of Hormuz came near standstill, catching traders in a tight spot. The headline for the day sounded like a warning from the Middle East: oil markets on edge as X. The tension on the deep channel that ships use to head for the Persian Gulf has escalated because of the ongoing U.S.-Iran firefight and Yemen's Houthi rebels. According to data from maritime tech company Kpler, only 20 ships sailed through the strait during the weekend. Of those, 18 used Iran's corridor that the government has been insisting on, while the remaining 2 managed to chart a course along the Oman side. Iran says it stepped up attacks on vessels that enter its waters and it displaced trade. The state's foreign ministry announced on Monday that mediators had presented proposals to rebuild the U.S.-Iran truce that broke down last month. That exchange lifted prices a little, but then a sharp rise came back on after the Houthi militia in Yemen threatened to impose a maritime blockade on Saudi Arabia. The rebels' claim threatens a blockade in the Red Sea, potentially shutting one of the main alternatives to the Strait of Hormuz and pushing prices even higher. The market, which had been under a steady wobble, saw Brent crude, the world benchmark, hover around $88 per barrel on Monday. It surpassed $90 early in the day, the highest level in more than a month, akibat an almost unexpected outburst in volatility. East Texas isn't as wild but fell 0.4% to about $82 a barrel. Investors and analysts are checking a handful of things. First, how many ships will keep sailing the strait and how many will turn to the wider Red Sea route RSI? Then, the spotlight on China, whose demand is crucial for global pricing, and lastly, the damage to Ukrainian refineries after new or continuing Russian attacks, which would also hurt supply for the world's biggest diesel exporter. The war in the region has turned the strait into a battlefield for regional power players. After the US and Israeli retaliations 5 months ago, Iran effectively blocked about 1,000 ships and tourists stayed away. The truce signed by President Trump and the Iranian leader on June 17 led to a surge of traffic, though it still wasn't anywhere near the 130 or so vessels that used the channel daily before the war. As the truce dissolved, traffic has steadily dwindled. While inventories across the globe are cold smokier than when the war kicked off, the current state of these markets highlights the fragility of the supply chain and how quickly politics can reverberate across oil prices. Each new development in the Middle East carries a ripple effect that can tell long-term economic trends. That's the tale we'll keep following as the region stays on a knife edge. Thanks for listening. Next week we'll dive into how deeper supply disruptions could shift the global effort. Until then, take care and stay tuned.